Good time then to bring on board Gautam Chacharya from UBS. Gautam, hi, morning. Let's start first talking about the rupee. Does it seem like this could create havoc for equities as well?
Good morning. Again, if you look at history also, apart from periods where rupee moves in a very, very sharp way, and when I say sharp way, it has to be meaningful move, not just marginal move, then only it creates impact on equity markets. Otherwise, typically we have seen historically it's the other way around. It's more rupee following the equities because capital flows plays a big role in terms of rupee fundamentals also in the near term. So I will get worried about rupee if there's a sharp move up towards 59.60. In a short period of time. A gradual depreciation or move, specifically given the way dollar is moving against other currencies, not just rupee, that in itself may not cause equities to react in a very negative way in a short period of time.
But Gautam, it doesn't seem any better for equities as well. It's been a turbulent last few days.
Yes. So again, there is causality and also two independent events possibly. But Indian equities is kind of following the global environment also in terms of global macro environment and global equities markets per se. So you've seen US markets also feeling the pressure. You've seen what's happening across Asia. So I think it's not that India is falling off because of rupee specifically or any local issue. It's just following the trend. And again, to put in perspective as the way what we tell our clients is two things. One, markets had a good run, so there will be some profit taking. Secondly, in terms of valuations or the market trading range, we have been talking about a Nifty trading range of 5,500 to 6,400, and again the risk reward had become less attractive post the recent run. So in that context, yes, this current correction even has some fundamental basis behind that.
Right, Gautam. Let's talk about your conference. It starts today. 30 companies, 100 investors, mid and small cap stocks is what you're planning to cover. But is there genuine interest to meet mid cap managements? Because the action is there only in few 10, 15 large cap stocks.
Yes, surprisingly, yes. So in fact, this is the third annual mid cap conference which we're having. And the last year the response was moderated. But this year we are seeing the response similar to the first year, which is 2 years back, and we're seeing more than 100 investors coming in, and in fact a lot of overseas investors also. So clearly the interest is there in the mid-cap space. But again, as we have been highlighting to investors that purely from a stock perspective, etc., we do not necessarily look at mid-cap as an asset class. As an index, it's not necessarily the best performing given the liquidity and other risks inherent in this category of stocks. So even historically, if you look at last decade, the indices in the mid-cap have not necessarily outperformed consistently or in a significant way. While bottom up, if you look at most of the sectors, the top performers would be the mid-cap stocks historically. So this remains a bottom-up space for us, and that's where even investors are looking at. So investors are looking at this space to look at ideas which can give them substantial returns more than what the broad markets can give them. So in that context, yes, the interest is still high.
Gautam, you track the mid and the small cap space with a magnifying glass, and historically I have seen that every time currency fluctuates, mid and small cap stocks either they gain too much or they lose too much. Have you done some kind of an sensitivity analysis on which mid cap stocks will gain when rupee will fall?
Again, for the broad mid-cap stocks index, no, there's no clear correlation. But yeah, individual stocks do get impacted, specifically where they are exposed to the currency either in the form of high debt or in the form of exports or imports. So those stocks do get impacted. From our coverage universe, which is the area where I can talk about more clearly, we have seen companies getting both positively and negatively impacted. For example, in terms of rupee moving very, very sharply, we have seen immediate negative impact on, say, a company like Exide in the short term. It's a company which we like, but in the short term, they can get adversely impacted by any sharp rupee move because that impacts their lead importing cost. But again, it also depends on how the lead dollar move price also is moving. Similarly, on the export side, you have companies like, for example, United Phosphorus, where they can benefit, but there again the cross currency rates will also matter, not just the single dollar rupee move. So again, there are multiple factors, and we look at more bottom-up ideas in the mid-cap space, and there, in our coverage universe, actually we haven't seen any one of them getting very, very significantly impacted from currency moves.
But Gautam, what is the broader tone you're getting from some of your clients? Are you getting a sense that global investors and local investors, they are now hungry for more ideas, they are ready to look outside that 1050 stock basket which has done rather well in last 1 year? Or are you still getting a sense that no one wants to take risk and they only want to buy those 10-15 stocks on every decline?
So if you look at the kind of money which has been pouring in for last couple of years in India from the for foreigners, it's largely the global funds, the GEM funds rather than India specialist funds. And these kind of funds typically will end up sticking to those top names rather than going beyond the index names into more mid-cap variety. So yes, that source of liquidity is definitely absent for the mid-cap space. Even among the locals, we have been seeing that local institutions and even retail investors, they have been selling equities for last couple of years. So even that source of liquidity has been absent for the small mid-cap space, and that's what's driven the underperformance of the small mid-cap space for the last few quarters. So from a purely liquidity and top-down perspective, I don't think that is going to reverse in a hurry, either from a foreign investor point of view or from a local investor point of view. But having said that, even over last 2 years, if you look at the broad mid-cap space underperforming, you have seen individual bottom-up stocks doing very, very well. In fact, some of them have been stellar performers. You look at Havells, you look at TTK, etc. So they've done very, very well, even in a period where mid-caps have underperformed. So individual bottom-up ideas will get attention even now. So because beyond the GEM funds, beyond the large-cap global funds, you do have GEM small-cap funds, for example, and you still have India-dedicated funds, though in smaller size compared to earlier, but they're still around. And if they see an idea which is very, very convincing and bottom up and looks like a great risk reward from a 2-3 year perspective where they can make significant returns, they will be interested for sure. And that's what we are seeing even now. So the interest level in a broader asset class sense is much lower, but on bottom up ideas per se, it still remains very high.
Gautam, is Just Dial part of your coverage universe?
Not yet. We don't cover that name yet.
But is the business idea per se looking interesting to you, and would you take a look at it eventually?
So obviously the business is an interesting space and a growing space, and we do cover a company called InfoEdge in the broad internet space, and at a broad so that business is doing well, and this is not completely similar, very different, but yeah, the opportunity is there, but we have to evaluate in terms of the stock and in terms of the company business model.
Gautam, you've also recently downgraded Emami to a neutral rating from your earlier buy. Is it because the stock has already seen a run-up of about almost 16% in the last 1 month, or now valuations look stretched to you?
It's purely valuations call. Emami used to be a top pick for us for last couple of years, but the stock has gone up phenomenally over last year and a half, specifically from its lows post the hospital issue in Calcutta. At the current valuations, again, we don't feel comfortable in terms of risk reward and absolute upside from current levels for investors from a next 1 year perspective. Again, the basic business model still remains robust, but from purely stock valuation and stock return upside from next 1 year perspective, it does not look attractive.
Gautam, the buzz is pretty strong around Reliance Communications ahead of Reliance's AGM today, and then of course there are news reports indicating that perhaps they may be striking a deal with MTN. Is it time to take a relook at this stock?
We don't have coverage on Reliance Communications, so I can't comment on that. But yeah, Reliance Industry is something which is definitely something which we like.
Gautam, at a time when consumption is slowing down, as a house you are not hot on consumption stocks. If I look at some of your preferred mid-cap picks, you like Bajaj Electricals, you like Exide, you like Redington. Now these are typically consumption-dominated stocks. So if the big picture argument for consumption is negative, why are you still hot on consumer names?
Actually, from an India strategy point of view, we have been underweight consumption for a while. And we have been arguing the same logic that purchasing power and real income trends for private sector employees, for government employees, for rural side is definitely on the way down. and that does not really factor into earnings estimates or valuations. So that is our strategy call anyway. Even if you look at the mid-cap space, we have downgraded or don't have a buy call on a lot of names which we used to like earlier, like a TTK or a Page Industries. Jubilant we have a sell. And now specifically these three names which you mentioned are more bottom-up perspective. For example, Bajaj Electricals is very cheap. It's trading at 9 times forward versus peer group trading at 20 times plus. Primarily because of concerns on their projects business, which in our view is a question of time. In a couple of quarters that should be behind us, and once that happens you will see the markets focusing back on the consumer business, and the stock should re-rate. So it's more a re-rating call rather than the consumer business call. Redington again is in a way similar. Redington stock was punished on BlackBerry concerns. So BlackBerry concerns have played out, but not to the extent as to what markets were worried about. On the other hand, markets have been ignoring their Apple tie-up and upside. Even in the Middle East, their recent tie-up with Samsung is helping them. So those are the upsides which have been completely ignored, and the stock is much cheaper than history. So again, it's a mix of mispricing and re-rating potential from here. Thirdly, Exide also has been punished over the last 2 years, and they did mess up on the business side for last couple of years. But if you look ahead, their main competitor is facing capacity constraints. Exide is already demonstrating pricing power over last quarter or so. Their margins have bottomed out and are picking up. In fact, we see potential for earnings upgrades as well as re-rating for the stock for the next 1 year. So all these three are not purely a consumer consumption sector call, but a re-rating call on the specific stock bottom up.
The Goa Chief Minister, Mr. Parrikar, has now denied or refused permission for a new casino for Delta Corp, and the stock is lower by about almost 8%. But Gautam, what's the view on pharma, which has been quite the shining pocket, barring a few eyesores like a Ranbaxy thereabouts? But what's your general view on the pharma space? What is it that you like?
So pharma space top down again, we are underweight on pharma because again purely from a valuation point of view, the stocks are way too rich for our comfort. They have had a good run over the last few quarters. Again, the business model is still intact. They're still doing well, but the valuation comfort is not there, and therefore we don't recommending from a strategy point of view any pharma names. Even though Rupee is kind of on the depreciating trend, so we prefer the IT services space rather than the pharma space to play the Rupee depreciation theme. In the mid-cap space, in the pharma space, we do like Ipca Laboratories. So that's one name which we have even in a conference, and we like the name.
Why do you like Ipca? Because Ipca is a very low margin business, and if I look at the numbers what they've reported for the quarter gone by, I mean they have EBITDA margins of about 20% plus, which is lowest in the industry.
Yes, so again, as per our analyst, the view is that should turn around, and both the international as well as the local business should improve from where they are now. And again, valuations is supportive for them compared to the overall sector.
So Gautam, if you have to, let's say, construct a portfolio which only contains mid-cap stocks, make a portfolio of 4 or 5 stocks.
So again, the three names which you began with, they will definitely be there. Redington, Exide, and Bajaj Electricals. Purely bottom-up idea. Similarly, I'll have Coromandel, again a bottom-up stock which has been beaten down, so it has potential for both earnings upgrades as well as re-rating potential. So Coromandel will fit in there. Then I'll be putting in Info Edge. Again, that has derated a lot, but the underlying is strong, and there is a potential for them to surprise positively on the real estate portal, 99 acres. So that looks very, very interesting to us. Then we also like Kanhaiya Ceramics, which we just initiated recently. The stock has done reasonably well, but I think it also has a lot of re-rating potential. We have seen this play out in the broad consumer durable appliance space over the last few years. We are seeing that play out in initial sense in this space. Kanhaiya has re-rated from single digit to low double digit P multiples, but it can re-rate a lot more from here. It is far more stable for that kind of business. So these would be the top picks for us at this stage.
Any reason why you are giving capital goods stocks or engineering stocks a skip? Because the consensus on the street is that Indian economy will recover. These companies have low utilization levels, and if economy recovers, they certainly would benefit.
Yeah, they would definitely benefit. In fact, from a strategy point of view, that's our kind of view also. The only name which I would have put possibly is, and that's there in that portfolio also, is Blue Star or even arguably Voltas. Beyond that, the problem is that the visibility is far beyond our forecasting horizon of 1 year. And secondly, in terms of even the current balance sheet, etc., when you're trying to look at or make a call on a stock, if your balance sheet is not under control currently, then you do worry about whether the company survives or not. So in the case of Voltas and Blue Star, we have that comfort that even now they are broadly profitable, specifically Voltas. The balance sheets are under control and they should be in a position to participate from a recovery. So these stocks will definitely put it in as preferred picks.